Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Poniotu, certified financial planning professional in the Cap and Capitalize. Today's episode, we are going to get into 401k mistakes, which unfortunately are all too common, but fortunately, I'm here to help you out with it. But before we do that, as always, I'm going to get into the free advice for the day. Price is what you pay, value is what you get. There's a reason why I'm saying that. Since we are in the midst of peak tax season, so if you're a CPA watching this, that is shocking because you should be working to the bone. But it is worth noting that if you are using these free apps out there, like TurboTax, versus like actually hiring a tax professional to do taxes for you, you are probably losing out even though it is free. So full disclosure, my wife and I actually used TurboTax for years until we started our business. Life got a little bit more complex with investments, all of that. And then when we hired our CPA, it was interesting because he went back a couple of years, and even though we were filing free through TurboTax, and we did all of the prompts correctly, it's not like I fat-fingered anything, we actually got thousands of dollars back that TurboTax was incorrectly producing. And even though it was free, and that's the price, the value was next to nothing. So don't think of things as price. I'm not saying price isn't important. Think of things as value. So now we got that free advice out of the way. We're going to get into the 401k mistakes that I see all of the time, and we are going to correct them by the end of today's episode. So I first want to talk about common mistakes to avoid, not contributing enough to get the employer match. So a lot of people don't understand what a match even is within a 401k. And it's valuable for you to know that there's three ways that you can contribute to a company 401k, or if you work for a nonprofit, a 403b, or if you work for a government 457b plan. Okay. And there are differences between the three, but for this episode, just think of them all as basically the same. So there's three ways to contribute to a retirement plan. As an employee, there's a match, and then there's something called a profit sharing. We're going to ignore profit sharing for a moment because, frankly, it's something that you can't really control. Well, it's not that you can't really control it. You cannot control it. Your employer, the business owner, is the one that is going to be able to control that. So put that off to the side. You can't control a match, but if a company is providing you a match, maybe it's 50 cents on the dollar or dollar for dollar up to 4% or 3%, whatever that number is. You want to make sure that you put in at least that amount. So for example, if a company says, hey, we're going to match you dollar for dollar up to 4%, if you put in 4% of your paycheck, they are giving you an additional 4% into your retirement. That is a 100% rate of return on your money. I've been investing at this point for almost 24 years. I'd like to think I'm decent because if not, I would be gainfully unemployed. However, I have not earned a 100% rate of return. For sure, 100% guaranteed rate of return. I know compliance doesn't like when I say that, but when you get a dollar for dollar match, that is a guaranteed 100% rate of return on your money. Even if it's a 50%, so 50 cents on the dollar up to 4 or 5, whatever that number is, that's a 50% rate of return on your money. I cannot guarantee that. And no one can, okay? And if they do, they're lying and they should be thrown in prison. That's beside the point. You need to put up to that employer match. So one of your homework assignments should be going to your company and going, hey, do I have a match within my retirement plan? If you don't know. And if you do know, you need to ask, hey, how much am I putting into my retirement? And if you're not putting it up to the match, you need to do so immediately. Now, I get the caveat that life can come at us fast and sometimes you can't afford to get up to the match. That is okay, but I'm going to tell you, you want to do everything humanly possible to get as close to that match as you can. Now, I also want to talk about something that is really important, but not nearly as publicized in our industry, which is over-concentrating on a company's stock within a company retirement plan. So most 401ks admittedly don't allow you to do this because most companies that people work for are not publicly traded. I mean, I think it's like 98.5% of all companies in the United States are privately held or like privately traded. They're not open. So 1.5% of them are publicly traded companies like Microsoft or Google or whatever. So some of these companies allow you to invest in the stock within the company's 401k. Now, this can sound great for a number of reasons. It can sound great because you know the company. And so in theory, you should understand more of what's going on with the company as opposed to a mutual fund that's diversified across hundreds, if not thousands of different businesses that you have no idea what's going on. And then another theory of why this is a good thing is it aligns you with the incentive of, okay, well, if I'm investing my money into the business that I work for, well, kind of by definition, I'm going to work harder for that business, which means the company is going to grow, meaning the share price is going to grow and everyone makes more money on top of money. That's technically all true. However, you really got to ask yourself, first off, what company do you work for? Do you really understand what the company that you work for does? And what I mean by that is, do you know the numbers? Have you looked at the balance sheet? Have you looked at the income statement? Have you looked at the cash flow statement and seen how much money they're making every single year? Is that growing? Do they actually profit? Do they have free cash flow? All of these things should be going through your mind when you're going to invest in this company. And a lot of people would go, oh, I just kind of give up. Well, if that's the case, then you probably shouldn't be doing that in the first place. You need to go talk to someone professionally and get this handled immediately. But I also want to talk about having too much concentration in one particular investment because that can be a poor decision. Now, for those of you that are new to the podcast, welcome. For those of you that have been devout listeners for quite some time, you know my stance on diversification. I think it is highly overrated. I think it's overblown. And I think diversification conventionally is for those that don't know what the hell they're doing. However, I am never going to say that, oh, you need to have every single ounce of what you've got cooking in one company. For like 99.99999% of people out there, that is a very, very, very bad idea. I have seen people try to argue this with like Warren Buffett. 100% of his $100 billion fortune is in Berkshire Hathaway, one company. Well, that company owns hundreds of other companies. So joke's on you. That's not totally true. So for you, when you're looking at the company, you've got to ask yourself, you've actually got to ask yourself as an analyst, not as an employee, what this company is going to do for you in the long run, which I know is a really weird practice to put into place. But I'm saying that because if in fact your company is doing really, really well, aside from the bias that you work there and you have a worker's bias, then you could argue that you may have more of a percentage of your money in that company in your entire 401k or your portfolio as a whole. But if not, just because a company offers you to invest in the stock in which you work, like the company where you work at, that doesn't mean you're obligated to do so. And in some cases, you shouldn't be doing that at all. So talk to someone professionally, whether it's a certified financial planner. You could even, if you know of a chartered financial analyst, which is on the investment side of like what we do, or even call up a 401k professional and ask them what their opinion is. you need to get that taken care of. Now, another thing that I see way too often is taking early withdrawals and incurring penalties. So you can't take your money from your 401k until you're 59 and a half without taking a penalty. Technically, that's not totally true because there are some ways where you could take money at 55 or even a little bit earlier. But like that's beside the point. Think of 59 and a half is kind of your golden number, or round up to 60 if you don't like halves. So let's say that you have $10,000 and you're in the 25% tax bracket, just to make it really, really easy. And let's just say it's a traditional 401k. It's not Roth because that gets a little squirrely. So you take 10,000 out. What are you actually getting from that? Well, one, you're in the 25% tax bracket, so there goes 25%. Two, you have a 10% penalty on top of what you're taking out from the tax bracket side of things. And then there are some administrative costs that come into the early withdrawal because a third-party administrator who's doing all of the back-end planning and basically administration for the plan, they have to account for that. You're really only netting $6,500. So you take out 10,000 and you only get $6,500. Ouch. Like there's a reason why the ERISA Act of 1974 has marked this type of plan to be devoted to you and your retirement, not you as in today as a savings account. And like I said, life comes at you fast. Sometimes you got to do what you got to do. But there are also options out there where you don't just take an early withdrawal. You could take a loan from your 401k. You could take a hardship distribution. And as far as if you can or cannot do that, you're going to want to talk to your third-party administrator. Or if you have a 401k advisor, you're going to want to talk to your 401k advisor, and they will put you in the correct position to talk to the third-party administrator to get all of those answers. Because some 401ks do offer loans and hardships, others do not. It really comes down to where you work. Now, another thing I want to talk about is maximizing contributions. And this is before we get to the commercial break. So there's a number of ways to skin this beast. When it comes to maxing out a 401k, first off, I should tell you like what the maximum is, because you can't just put like all of your money into a retirement account or into a 401k. In 2025, during this recording, if you are under 50, you can put in $23,500. If you are over 50, you can put in $31,000. And for whatever reason, between 60 and 63, that catch up from the $23,500, instead of putting in another $7,000, you can put in another $11,250. I have no idea why Congress made that rule. That's just the way that it is. And I don't know why people ages 60 through 63 in this particular year get this lovely little perk and a benefit, but I don't write the rules. I'm just the messenger. So the reason why I'm saying all of this is a couple things. One, for those of you that are doing really, really well, you want to make sure you get to that maximum if at all possible, because the best investment return that you can guarantee is not actually an investment. It's the taxes you avoid. And if you need to re-listen to that segment, go ahead and do so because it's very, very valuable. Now, most people aren't able to max out their contributions to their 401k. That is okay. I have met people, and I've said this in the past, and it's worth repeating again. I have met people that have come into my office that have rolled over $1.5 million, $2 million, $3 million, even $4 million of retirement assets. And guess what? They never got close to that maximum contribution limit that I was telling you about, which is that should give you a ton of confidence knowing that, oh, I don't have to get to that absolute max. But if I do the best that I can, just like all of these other people have that have come into my office, I am going to be successful. That is true. That is 100% true. Now, there are also times when you're maximizing your contribution where sometimes the best way to add an extra percent or two of your paycheck to a 401k is to actually knock out certain debt payments. So think about like credit cards or other high interest debts. So the order of operations with this is if someone comes in, they have no idea where to go. Well, all things being equal, you want to get money in up to that match. So whatever it is, dollar for dollar up to 4% or 3% or 5%, whatever that number is. You want to do everything in your power to get to that percentage. But then anything after that, it kind of comes down to what your tax bracket situation is looking like. So if you are in a really high tax bracket, you're still going to want to max out your retirement plan. And generally speaking, if you're in a really high tax bracket, you're not going to have the credit cards or other high interest debts out there that are in the high 20s. But I have seen it, which is staggeringly mind-blowing to me. That's beside the point. Let's say, though, that you are in a lower tax bracket and you're still able to get up to that match. And you go, okay, well, where do I go with that? And your blended tax bracket is, maybe like, I don't know, 10 or 12%, but you've got this credit card debt out there that is 27.99%. Well, after the match, you want to go and make sure that you knock out that credit card debt because you would much rather earn 27.99% than 12 or 13 or 14 or whatever that number was that I said earlier, right? Right. And a lot of people get confused on that because then they start to go, okay, well, but what about the possible investment gain? I read this on TikTok, I read this on there, and I read this on Instagram. And if I go and invest this money and I avoid all these, it's like, no. Keep it really, really easy. Know what the rate of return is on your credit card debt or high interest debt, or really just debts in general. And we've talked about this on past episodes, so I'm not going to get into capitalizing on your debt. And then also understand what your blended tax bracket rate is. I actually want to touch on that. That's a very valuable tangent that you need to be aware of. A lot of people think that when you hike up to a new tax bracket, so going from 12% to 15 to 20, whatever the case is, a lot of people think, well, once I get to 20, now I'm taxed 20% on every dollar that I've made for that year. That is not the case. It's a progressively tiered ladder when it comes to taxes. So just to make math easy, let's say that if you make under $100,000, the top tax bracket you have is 12%. And then above $100,000 to, let's say, $140,000, you're taxed at 22%. The money that you make between $100,000 and $140,000 is taxed at that 22%. But anything below that 100, for the purpose of this example, is taxed at that original, whatever it was, 12%. So that's really valuable for you to know. Okay. And then when you look at the blended tax rate, you basically add all that up, you average it out. Then you kind of know what your true, for every dollar you make, what are you actually paying in taxes? Okay. So again, little tangent, little side note, but I thought it was really, really valuable. Okay. So the last thing is with maxing out the contributions. I already talked about it earlier, but it's worth repeating the importance of the catch-up contributions. So again, if you are over 50 in 2025, you can put in up to $7,500. Excuse me, it was the same as 2024. I misspoke from $7,000 earlier. It's $7,500. But between 60 and 63, it's an additional $11,250 from the $23,500 that I mentioned earlier, which is correct. Okay. So if you are over 50, that is all the better because you can put in that much more into your retirement, and you're going to want to do so if you can afford to do so, obviously. So we're going to take a quick commercial break. And then when we come back, we're going to talk about ignoring fees, rollover pitfalls, and then we're going to close this thing out. So stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth, Packed with strategies that go beyond surface level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We're going to get right into ignoring fees, which is a huge 401k mistake with an asterisk that you need to be aware of. So I shouldn't say every, because some 401ks you can invest in absolutely anything, but the majority of 401ks out there give you a set menu of investments that your owner or whoever the trustee is of the plan, the financial 401k advisor, and the third-party administrator sometimes, and the custodian who holds the money, selected on your behalf for your best interest. And so a lot of these investments out there, even if it's super, super, super cheap when it comes to an expense ratio, they have expenses attached to these investments. Now, I mentioned the asterisks because I'm not saying that fees aren't worth noting, because they are. However, people getting super locked in to earning as much as possible without paying as little as possible. Actually, as a side note, those are people you just don't want in your life. Like those are actually awful people. When you think about it from a policy standpoint, it's like, I want to make as much money as possible, but no one else gets paid. That's wild. It's ludicrous to me. And it's worth noting and it's actually not a tangent. This is very pertinent to ignoring fees. I've talked about this in the past. There's 3 types of people out there. There are, as far as mindset goes, there's poor mindsets, there's rich mindsets, and then there's wealthy mindsets. Poor mindsets, pretty cut and dry. Scraping pennies together. All you're looking at is how much can I save. Some of that is important, but it will be, in the long run, very detrimental. Rich, I could argue, is even worse because you've got all of the money and capital to go and make these investments, but you kind of just pinch everyone else out to maximize your pocketbooks and then shaft everyone else on the way out the door. But then wealthy mindsets understand kind of the free advice I told you earlier: price is what you pay, value is what you get. So when you pay for something, you should ask yourself, okay, but what is my rate of return that I'm actually going to get for this? And that quickly will shift your mindset from, I got to scrape these pennies together and just save as many fees as possible. And, the rich, like uber brutal, I would say like the bad side of capitalism. And I'm a staunch capitalist, but like I've never agreed with just pinching people out of every nickel and penny that they have. When you have that mindset of understanding the return on investment with everything that you do, and understand that there is a cost to having some form of success, you will alleviate so much stress in your life. It's really not even funny. Now, go back to why that's important to the retirement plan side of things. I've seen this with 401ks that we oversee. We have seen, and I'll just make an example. I'll make a hypothetical here. Let's say you have 2 companies or 2 investments that are trying to do X, whatever X is. And let's say investment A is better than investment B. Maybe there's a better investment manager. Maybe they have a better track record. Maybe their mentality with the future aligns better with what I think would be appropriate for the investors, et cetera. But they charge more than investment B. So many people, and I've seen this when I go and I talk to employees at 401ks that we oversee, they will latch on to, but there's an option out there that you pay absolutely nothing for. It's like, okay, sure, but you don't get really anything for that. And there are some people that charge an exorbitant amount of fees for these things. All I'm saying is for you, the grand scheme of retirement success is not going to be trying to go and find the lowest cost thing. That is these corporations prying on your emotional unintelligence, not even with money, but understanding the value of a wealthy mindset. The grand scheme of things, your most important thing that you're going to have to do when it comes to retirement success is actually doing the thing, saving that money, systematizing it, setting it and forgetting it, but also understanding and verifying from time to time what's going on. And then you do that for 40 years, assuming you're 20 years old. That's where you're going to become massively successful. And so what? If you know what, people are getting paid to help you succeed, and for every dollar that you give them, they're able to pay you $2 to $3. Fantastic. Actually, a really quick side note, Vanguard, which is known for having super low cost index funds, never want to have an advisor, et cetera. Ironically, they shot themselves in the foot because I think it was 6 or 7 years ago, they actually put out a white paper. You can go and Google this on the value of an advisor that gives truly comprehensive planning advice. And I'm going off of memory here, but if you allowed an advisor to charge what they charged, a good one, okay, not a sleazy scumbag, an actually good, honest, decent, certified financial planner, they would add approximately 3% to your overall return as opposed to you not paying them. So by paying them, you would have 3% compounded every single year. And that adds up in a massive way. And there's tax strategy, there's debt mitigation, there's all kinds of things. But I always find it ironic how the one company out there that promotes advising in true planning as being a farce actually shot themselves in the foot by producing a very sophisticated and well-written white paper on why they are wrong. I just thought it was kind of funny. Now, the last thing I want to talk about is comparing plan fees and finding lower cost options. So a lot of people, and this is a very valid question, they'll come to me and they say, well, Chris, should I go and contribute to my 401k, or should I contribute to an individual retirement account or a Roth IRA, or even just an investment account? And you got to think of those accounts kind of in two separate ways. So if you go and buy bulk, you generally go to Costco. Think of your 401k as the Costco to your retirement. If you're just going to go pick something up at the store, you're going to go to your local mini mart or gas station, wherever you go. Now, if you do that, you're not going to be spending as much, generally speaking, as Costco. However, you're paying retail pricing. When you go to a company like Costco for all these bulk orders, you're buying it wholesale, which means the cost per good is a heck of a lot cheaper than going to the actual mini mart. So for you to be the absolute most successful humanly possible when it comes to retirement, you're going to want to make sure that you max out that 401k first before you put a penny into any of these individual options. And there are reasons for it, even aside from the cost. Number one, matches. You can't match yourself, okay? And so you want to make sure you get the free money, even though you're able, and not even though, on top of the match, even if you're able to go past the match, and at that point, you're just putting in what you're putting in, the fees for your 401k, generally speaking, are going to be cheaper than going out and doing it individually. And then the third thing that you need to think about is just the simplicity of it all. I've met people, and man, it's a great life. They've worked for the same place for however many years. They come in, they're getting ready to retire. They've got their home, some cases paid off, some cases not, a checking account, a savings account, and their IRA, which then rolls in, if their 401k, which then rolls into their IRA. And that's it. And that's great. Simplicity is a beautiful thing. Like $1 million doesn't care how many accounts you have. The fact is you have $1 million. So when it comes to your 401k, there's a myriad of reasons as to why that is going to be the first route of attack before you do an individual account. Now, obviously, I'm not against individual retirement accounts. I'm not against Roth IRAs or individual accounts. And if it comes down to tax season, like right now, and you look and go, whoa, if I contribute $2,000 to my IRA, I can further reduce my tax burden or whatever the case may be, then that is where you could take any money that you may have off to the side and contribute to these individual accounts to really just squeeze the blood out of the turnip and earn as much as you can on the taxes that you're avoiding. Or if it's Roth, then you're putting money in tax-free and then you grow that, et cetera, et cetera. So you just need to understand the difference between the two, and that's really, really valuable. And then the last thing we're going to talk about is rollover pitfalls. Now, my compliance is probably shaking in their boots because we're not really supposed to talk a ton about rollovers. However, it is incredibly valuable, and I don't really care because I'm here to tell you what you need to know. I'm not here to hide behind compliance. So when it comes to rollovers, there's a couple things you need to understand. So let's say that you go from company A to company B. Well, your 401k is still at company A's 401k. And you go, what do I do with that? Well, there are a couple options that you need to know. Number one, you could leave it right there. There's nothing wrong with that. Number two, if your company, your new company that you work for has a 401k, you can roll that money in to that retirement plan. Same thing as a 403B, same thing as a 457. Sometimes you got to ask to make sure that those cross-pollinate, but like if it's a like kind 401k to 401k, there's no reason why you can't roll that in. Same thing with Roth 401k to Roth 401k. You could also, if the company that you work for doesn't have a retirement plan, you could roll that into an individual retirement account, or again, if it's a Roth 401k, you could roll it into a Roth IRA. Or you could cash it out, which we obviously have said at the beginning of the show, you don't want to do that for a myriad of reasons. Penalties, taxes, I'll be disappointed in you, et cetera, et cetera. Now, obviously there's pros and cons with all of these, and you're going to want to weigh all of those. Costs are a thing. So all things being equal, if company A's 401k actually does have a better fee structure than your current company, or if company A has a really good 401k fee structure, you don't have a retirement at company B, you may want to keep that money at company A and then open up an individual retirement account and then start contributing that way, because that's the best way you can control your fees when it comes to a rollover. There are so many pros and cons on either side that frankly, I wouldn't have enough time to go through it in this episode. But obviously the one thing that a lot of people look at with IRAs and Roth IRAs is they go, well, I can get more custom with my investments. Yeah, that is very, very, very true. And especially when you've retired, there's a myriad of options that, like, I know we can provide that you simply won't get in your 401k, which is fine. Because with your 401k, when you construct a menu, it's kind of like herding cats. And you all know how I feel about cats. But that's beside the point. Just because you can get more custom, especially for people that are listening in their 20s or 30s, I could argue even 40s. A lot of people in our industry will pray and go, hey, well, I can invest better in the market for you. It's like, well, okay. Anytime someone says that, I think that's the wrong approach to that conversation. But what I'm getting at is investing in the stock market. It doesn't matter if it is a stock or an ETF, or commonly referred to as an index fund, or a mutual fund. Like, think of it like going to Baskin & Robbins. If I like strawberry, you like vanilla, your best friend likes chocolate, like, we're still getting ice cream. We're all in the ice cream shop. So even though we're getting different flavors, we're still consuming basically the same amount of calories, and we're leaving equally as fat as before. So think of it like that. And so when you think of that, all things being equal, then you go, okay, well, the cost of keeping that at company A or rolling it to company B, that's where it becomes really, really important. But don't try to get cute when it comes to your 401k or your retirement in general. Keep it as simple as possible for as long as possible. which frankly, I think that is a perfect place to wrap this episode up. I had a fantastic time doing research on this. I could have gone on for many, many, many more hours, but my marketing team would have shot me in the face. So I'm going to wrap this up for this week's episode on 401k mistakes. I will see you next week. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counseling of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Christopher Panayiotou is a registered representative with and securities advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning.